Hey everyone, this is Adam here with SkyviewTrading.com, and today I wanted to compare the SPY versus the SPX, so SPY versus SPX. The SPX is the S&P 500 index and SPY is the S&P 500 ETF. So as a retail trader, how do we choose between trading SPX options versus SPY options? Let's compare vertical credit spreads on each product. First, it is important to note that to get the same buying power effect, you will need to sell 10 times more contracts in the SPY than the SPX. So basically the SPX is 10 times the size of SPY. So if you sell one SPX 1700 by 1710 call spread for a $3.30 credit, that's equal to selling 10 SPY 170, 171 call spreads for 33 cents credit. So like I said, the max gain and max loss are both going to be the same on both of these trades. So if you sell, the one SPX spread, your max gain is 333, your max loss is 667, and you can see over here on the SPY trade, your max gain and max loss are exactly the same. So if the max loss and max gain are exactly the same on each trade, how do we know which one is better? Well, here's a few things to note. The SPX, the markets are much wider, even though it is 10 times the size. In the SPY, the markets are typically 1 or 2 pennies wide. And let me just show you this real quick on the Thinkorswim platform. And if we go to the SPX options, and we'll go in October, and we will arrange the spread to vertical. If you notice these vertical spreads, if we wanted to sell the 1705 by 1700 put credit spread, the bid is at 20 cents and the ask is at $3. That's really wide market. So if you wanted to sell this at the natural price, you would sell at 20 cents and buy at $3. That's a big disadvantage. But on the flip side, if we go into the SPY and look at the options in here, you can see the bid-ask spread is a lot tighter. So instead of 20 cents to $3, this one is 24 cents to 30 cents. Also in the SPY, there are up to 10 different exchanges competing for your order. And in the SPX, there's only one exchange competing for your order. So in SPY, basically 10 different exchanges want your business and are fighting to fill your order, versus only one exchange that, they know they have your business. One more thing to note, the SPY pays dividends quarterly, so there is a bit more premium embedded in these options for the dividend risk. Also, there is a bit more premium for the exercise risk. There is also one extra day, as these expire on Friday evening and SPX options settle on Friday morning at the open. In spite of all of this, I choose the SPX over the SPY for two reasons. The first reason is the IRS treats indexes differently than stocks, or ETFs. Profits on indexes are taxed as 60% long-term at a 15% tax rate, and 40% of the profits are taxed at short-term, or the 35% tax rate, no matter how long the position is held. Also, commissions on 10 vertical spreads for me personally is $50 round trip. So it would be 20 contracts on entry and then 20 on exit. So $50 round trip versus one vertical spread would be $5 round trip for me, which would be 2 contracts in and 2 contracts out, which I have found allows me to manage the winner a lot easier. So let's take a look at these options again. Notice that on the SPY, the mid price here is 32 cents. We would have to do 10 contracts to match the trade size of the SPX. So on this spread, we would likely be able to fill at 31 cents. So that's pretty much giving up, $10 in potential profit. And if we go to this same trade in the SPX, which would be the 1710 by 1700, we can sell one contract and have, about the same credit. And, the natural price on this is $2.20. But from experience, I've found that I can usually fill, at the mid price or at least 5 cents under the mid price if I work my orders in SPX. So, even if you give up 10 cents on one contract, that's the equivalent of giving up 1 cent on 10 contracts. So giving up 10 cents on the SPX really isn't as big of a deal as you might think, because it is 10 times the size of the SPY, and filling 10 cents below the mid price is actually fairly easy on SPX. So alright everybody, I hope that kind of explains why I usually like to trade the index options over the ETFs. So like the RUT over IWM or the NDX over QQQ, because these indexes really cut down on transaction cost and taxes. So that's what I have for tonight, and I'll see you all in the next update.